Great. Okay. So the agenda for today, we are going to start by covering at a high level, what is the incubator? Why does it exist? What is the hackathon? Um, who are the partners involved in helping build this experience? What is the directory and all the projects that people have been built during this cohort? We'll get into the presentations themselves, a lot of great projects that we've curated to show off, and then we'll reveal the prizes for this cohort. So very excited to kick things off. So at a high level, what is the Uniswap Hook Incubator? This is a program that was built to encourage people to build on Uniswap v4. The way we designed it was to infuse elements of what we think makes great educational programs. So you have the curation of an accelerator where we're screening for experienced developers. We build and we ship and we optimize everything around this. That's why you're here today. And then there's tons of structure with workshops, office hours, curriculum, to guide developers to get to where they are today. We're really proud of the people that end up joining the program. We have experienced Solidity developers, obviously people that are curious about DeFi, and we're really proud to have founders, hackathon winners, researchers, all kinds of interesting people that join the cohort. And it's pretty broad in the ecosystem. We're starting to see auditors also join as well. This slide has some fun little shout outs of kind of the taste of inside the experience. We play trivia together, we give shout outs. So thank you, Manu, for kind of spearheading all the social efforts here. We also meet up in person. So this is a fun little picture from Uni Day. We had a 61 person group chat going with folks from UHI, where I was able to give a little talk about what we do at Atrium. And here's a snippet of the people who are there. It was very hard to coordinate group pictures, but I'm glad we did it at Unichain. And thank you for everyone who's there in person. I want to give a moment, if Devin is in the room, if we can confirm. I would love for Devin to give a quick shout out to why Uniswap Foundation decided to fund Atrium, and kind of what Devin is most excited about with this cohort. So Devin, if you're here, we'd love to
Yeah,
have you say a few things.
I'm here. Thank you so much, Bomik. I am the executive director of the foundation, and I guess I wanted to open by just saying one thing I consistently share with folks when I talk about the foundation is that I think the best grant we have awarded is to the Uniswap Hook Incubator, is to the Atrium team. And it really has been an incredible opportunity being able to see them grow and evolve, seeing the Hook Incubator grow and just get better and better over the last year or so. And a big part of that is, of course, Bomik and his team, their expertise, their focus and passion for making sure all of you have the best experience possible. But I think an even bigger part is all of you. I have consistently seen this group of developers show an enthusiasm, show a focus and determination to build and innovate that really is a breath of fresh air. Like on my hard days, seeing you guys tweet about what you're building is what gives me like motivation and like turns my day around. It really is the reason that all of us at the foundation are here. I am consistently impressed, as Bomik said, by the caliber of people who join, and also by what all of you end up building. Our dream with this program is for the next Uniswap Labs, the next unicorn, like literal unicorn crypto team to come out of this program. And I think we're going to see that. I think you guys are going to make that happen. Next year is a big year. I think next year is the year that we really, we have the people. Now the foundation's role is to work with all of you to help you guys make that happen, to build the next, to build the first Hook unicorn. I'll just plant that seed in all of your minds. Like, we are so excited to make that happen. That's our goal. We're gonna work with you all to make that happen. We're so excited about that. And I think, today is maybe day one of that. Like, let's see what you all have built. So thank you all again for spending all of your time on the program. Thank you to Bomik and team. Thank you to all of you for putting in the time and work. And I'm really excited to see what you've built today. Thanks, guys.
Amazing. Thank you, Devin. That was awesome. Always a jolt of energy every time you share the broader impact of what we're doing. Okay, so without further ado, let's start talking about what is the actual hookathon. So the last 2 weeks of this 2-month program is built to have people ship their own unique hook. They've been spending the previous 6 weeks learning all kinds of concepts on what is possible via V4. And so this is the opportunity to showcase what you've been learning and your creativity. So we have a 2-week kind of demo day period. And you can see these details on hookathon.atrium.academy. And there's office hours, support, all kinds of exciting things. And what's been really interesting over the last couple of cohorts is seeing companies in the broader DeFi ecosystem, crypto ecosystem get involved and want to get in front of DeFi developers. And we were very excited to have in this cohort Arbitrum and Eigenlayer as a primary sponsor. And they did a lot of great work in educating developers around their specific ecosystems and why their products would be great to build on for DeFi developers. So we're actually going to have both Arbitrum and Eigenlayer spend a few minutes talking about their respective products and why they're excited to interact with V4. So Wes, you're here from Eigenlayer. If you don't mind unmuting and sharing a little bit about what is Eigenlayer, the experience kind of working with the developers, and what you're excited about with V4 as well.
Absolutely. And let me just check, is audio coming across okay?
Yes, it's perfect. Thank you, Wes.
All right. Well, thank you so much for letting us participate. We have long been fans and have, I would say a lot of our folks are also heavily involved in the Uniswap Foundation. So there's a lot of shared love between the organizations. And, you know, with the Uniswap V4 hooks, it opens up a lot of possibilities and also a lot of opportunities for integration with Eigenlayer. To give you guys just a very brief background, folks that haven't worked with Eigenlayer, we're a restaking platform, but we're providing a marketplace for trust, decentralized trust. And really what that means is taking services that folks might have had to have built off chain or as an app chain and building them as validated services. So we're taking existing capital assets, maybe native Ethereum, delegating that to a network of operators, and then letting folks build their own off-chain services. And so it was really impressive to see the different things that the community came up with throughout the presentation, throughout the hackathon process, things around automating the restaking process through Uniswap hooks. People had built out AVSs to build more robust pooling and matching services using the hooks. There's just a ton of really interesting ideas that folks who came up with. And so we're very appreciative of being able to participate in the process, and we're looking forward to hopefully lots more innovation and work together with the Uniswap team and Atrium teams in the future.
We'll make you unmute.
Sorry, I was muted. I was saying, yeah, thank you, Wes and Eigenlayer team for getting involved very early. There's a lot of cool projects from Eigenlayer in this cohort, but definitely look into our hook directory for previous cohorts as well. Next up, we have Arbitrum. And Chinja, if you're here in the call, I would love for you to say a few words as well.
Yeah, for sure. Hey, everyone, I'm Srinjoy, PM at Off-Chain Labs, based out of Vancouver. I work on a product called Stylus. And Stylus is a way to write smart contracts with WASM-based languages that run interoperably with our new WASM VM on our Nitro nodes. And so, you know, when we saw Uniswap V4, especially the bootcamp come out, we're very excited to be a sponsor for Atrium. You know, first of all, just loved all the projects that everyone built, and thank you for spending all the time and effort into building those. You know, we're reviewing them, and we absolutely loved watching people build with Stylus. But for others on the call, just wanted to cover really quickly, you know, what makes the synergy between Stylus and V4 so awesome. You know, as all of you know, you get this incredible amount of flexibility with how you create your liquidity pools now. But with this flexibility comes, you know, obviously challenges with a lot of the advanced use cases, whether you're doing like dynamic pricing or certain types of risk management. A lot of these can be pretty cost prohibitive or completely infeasible, especially when it comes to on-chain computation, mostly because of like the gas costs and limitations. And that's really where Stylus shines. It allows you to write hooks in Rust. You get to leverage the decades of compiler optimization and all the libraries to produce really efficient code that can run on a RWASync VM. And the result is that it's going to consume significantly less than Solidity, in orders of magnitude less, and hopefully make the previously impractical ideas and now very possible on chain. And it's not just being able to write the logic, but you're also able to leverage Rust's entire ecosystem of pre-built libraries. Obviously, not everything's going to work in a blockchain environment, but a lot of them are going to help you or save you from reinventing the wheel on a lot of the primitives and help you focus on building the actual solution. And just kind of zooming out, the bigger picture isn't just being able to write smart contracts in Rust or use the RWASync VM, but what sets Stylus really apart is that it doesn't operate in isolation. It's deeply integrated with Arbitrum. So if some of you remember, Arbitrum was one of the first L2s to cross 200 billion on Uniswap a couple months ago. So we really offer this unmatched liquidity and thriving DeFi ecosystem, and you're able to plug directly into all the Solidity contracts that exist. So, in summary, it really opens up this new frontier for like DeFi, where the key to unlocking these use cases beyond Solidity and optimizing your hooks for efficiency come from this like unmatched combination of Rust, Solidity, and Arbitrum ecosystems all coming together. But yeah, that's why we're really excited, and not only for the builders of this cohort, but we hope everyone gets a chance to take a look. Head over to our documentation and website to just find out more. But yeah, very excited for demo day.
Thank you, Shinjoy. And we will follow up to everyone who attended demo day with links to both the documentation for Arbitrum as well as EigenLayer and this page that is requests for hooks. It's all kinds of ideas for what can be built on both EigenLayer and Arbitrum. But yeah, thank you to the sponsors for the education and also contributing towards the prize pool for the developers. So let's jump into what was like a overview of the cohort experience. So we had 160 plus Solidity developers that joined the program. 89 devs ultimately joined the hookathon, and we saw 57 unique capstone projects get built. And we have our largest ever prize pool for this cohort. So we're excited to the impact of this specific cohort. These developers that I mentioned, they all filled out a submission form where they shared the problem they're solving, the impact, the challenges faced, how they might want to extend the project. In this demo day, we're only able to see 10 of the presentations. So I highly encourage you to go on projects.atrium.academy. There's actually 10 prize winners that just didn't have time during this demo day to present. So I would love for you to go through all the projects, filter by specific tags, like, what technology they integrated, if it's a KYC hook, things like that. It's all possible on projects.atrium.academy. So please check it out. If you would like an intro to any team, you're welcome to reach out to team@atrium.academy or DM me at Telegram. But yeah, very excited for the projects that went out. And I want to further emphasize that every person in this program that completed the hookathon is now a graduate of UHI. So congratulations to everyone who made it this far. We are excited to send you on-chain certificates of your progress. It'll have your name, the project you worked on. If you want a prize, a little sticker for that. We'll also send you Atrium swag if you graduated, and expect more updates about other opportunities to continue to showcase what you're doing and get involved. So as an example, Uniswap Foundation has an ambassador program that recruits directly from Atrium graduates. And we also highlight developer stories. We just started doing that. So these are posts that went out this week on our blog. So expect to stay involved. We're going to have an alumni telegram set up next week, alumni newsletter. So this is not the last time you're hearing from us. This is only the start of your journey with continuing to build on Uniswap. Okay, so without further ado, let's get into why we're here today, which is demo day. I'll give an overview of the order, and then I'm actually going to have Hardik be a light commentator given his role in helping educate all the teams here and helping judge a lot of these projects. So this is the order that we're going to have the demos in. Each team will go one by one. Hardik will just, provide some commentary between the projects, and then we'll reveal prizes towards the end. So without further ado, let's have Team Tenor go ahead and present.
All right, very nice to be here. So I'll share my screen to show you the project we built during the incubator. Let me start with the slides. We're building Tenor. I'm one of the co-founders here. We're building fixed rate lending markets using a custom Uniswap v4 hook. Some quick background on myself. I worked at Notional Finance for about 3 years before starting Tenor, and my two co-founders, Hugo and David, worked at Morpho for a bit. So let's jump right in. So what's the problem we're tackling here? When you look at on-chain lending markets today, all of it is done using money markets, protocols like Aave, Compound, Morpho, Euler. And while they have like a lot of product market fit, these money markets are really inefficient, meaning there's a kind of high kind of interest rate spread between what borrowers pay on one side and what lenders receive on the other side. So it's really inefficient. And also money markets are really volatile, meaning rates update kind of block to block, and it creates a really bad UX for borrowers because sometimes if the rate kind of spikes, they need to unwind their position. So what we're building here with Tenor is a fully on-chain lending order book where we can match lenders and borrowers at fixed rates. So a lender could say, I want to lend at 8% fixed, and then a borrower could match kind of peer-to-peer with that lender, effectively cutting the massive spread of money markets. So it's more efficient and also brings more stability and a better UX to the market. So that's that. And then the actual kind of technical solution we're building here is a Uniswap v4 hook. Our hook allows to trade interest rates, whereas kind of the traditional kind of Uniswap protocol allows to trade prices. So instead of trading prices like you would do with Uniswap v3, where users swap kind of USDC for ETH at a given price, with Tenor, you can swap USDC for a USDC fixed rate token that matures at a specific date at a given interest rate. And the way we enable that is we built basically an AMM with interest rate ticks instead of the traditional kind of Uniswap price ticks. And we had kind of a custom formula to that. So that's the technical stuff. Let's jump right into the demo here. So all of this is on DevNet. So users that want to lend, they can select the currency, let's say USDC, choose their maturity, 1 month or 2 months, enter the amount they want to lend, let's say 1,000 USDC, and they'll get quoted an interest rate based on the liquidity in the liquidity pool. So let's say we increase the amount here, we'll see that it goes through kind of multiple ticks to quote the interest rate. And basically, as I mentioned, like this liquidity pool here is to trade USDC for USDC fixed rate tokens. Similarly to Uniswap, we have ticks, but instead of price ticks, it's interest rate ticks. We have the borrowing demand on one side, lending demand on the other side. And all of this is fully functional. So let's say if we want to lend some USDC here, we can just approve the contract like this. Deposit the USDC, and then execute the lend transaction on our v4 hook. All right, and just like that, the transaction was successful. So we can look at the transaction trace on Tenderly. And yeah, that's basically what we implemented so far. And one thing that's really nice as well is we layered on top of the kind of AMM also limit orders. So if a user doesn't like the rate they get quoted in the liquidity pool, they can always just say, let me put like a massive kind of limit order at 15% or whatever other rate they prefer. And then they can get matched peer-to-peer with borrowers. And another cool thing that we did is we are building all of these order books on top of existing money markets. So while your liquidity spending, it's all deposited in an underlying kind of Morpho money market. So that's the quick demo. Borrowing also works. It's basically just the other side of the market. So there's that. And what we're effectively building here is the Uniswap earn feature. So on Uniswap currently, you can swap, set limit orders, buy some cryptocurrencies. we're building with our hook the earn feature, so you can basically enter an amount you want to lend, get quoted an interest rate, and execute the transaction. And it really allows for kind of any protocol to deploy these Uniswap lending pools on top of their existing money markets. So Morpho curators could do that. The Aave DAO could even kind of deploy fixed rate lending markets using Uniswap v4. And as far as our progress and roadmap, currently all of the contracts are deployed on the DevNet. We have a live version of the app. We got 2 market curators lined up to deploy early next year. And next step for us is to go to audits and then launch early next year. So I mentioned like our team knows the lending stuff quite well, just because of our time at Notional and Morpho. And that's pretty much it. Hope you guys enjoyed it, and feel free to reach out on Twitter if you want to try the demo out or just ask any questions. Thank you.
Amazing. I love that. When I saw this project during judging, is like such an interesting use case of like, you know, custom price curve based hooks, and a very like novel way to like frame the implementation of like Uniswap and ticks and how it all works. So it was very, very interesting, and seeing like how complete it was as well. That was pretty cool. You know, fully working front end and like a plan beyond the hackathon and stuff. Amazing work, guys. Amazing work.
Thank you.
Cool. Next up, we have Dynamic Shield. If you could please unmute and share.
Okay. Let me present my screen real fast. You seeing it right?
Yep.
Okay. All right. So yeah, hello everyone. Thank you a lot for the opportunity. Very excited to introduce Dynamic Shield. It's a hook designed to minimize LP losses, and in doing so, incentivize more and more investors to become liquidity providers. I'm Rafael from Pool Party Protocol team, first decentralized social finance protocol that simplifies liquidity provision for less experienced investors on Uniswap. I'm here with my team members and co-founders, Wellington, Murillo, Arthur. I have been building the DeFi market since 2017, and some of our recent highlights include like creating first RWA tokenization platform authorized by the regulatory authority in Brazil, and also participating in the development of major protocols like Eigenlayer, Diva, Nectar. Yeah, basically, impairment loss is the main challenge faced by liquidity providers, causes a lot of them to stop operating in the market, thus compromising efficiency. This occurs when the prices of the assets in the pool diverge, generating a lower return in LPs compared to simply just holding the assets outside of the pool. And additionally, when the LP position moves out of range, they stop earning fees. Remaining exposed to weaker assets and face a lot of risk devaluation during market downturns and all of that. With this in mind, we created the Dynamic Shield Hook. We'll explain in detail shortly. It focuses on minimizing the IL through dynamic fees, allowing the LPs to receive more fees during periods of higher market volatility. Also converts the volatile assets into more stable tokens such as USDC, USDT, or even Ethereum when the pool's out of range during bearish movements. Once the market recovers, the token is converted back into the original asset and can be re-added into the pool when it's about to return to the defined range. And finally, we also designed an incentive mechanism that offers rewards inversely proportional to the fees charged by the LPs that enables protocols to encourage them to provide liquidity for their tokens with lower fees. Imagine a pool, like with any liquidity profile as shown in the following example. When the LP creates a position using Dynamic Shield, for instance, with a dynamic fee ranging from 0.05 to 1%, their position, that's shown purple in here, has a dynamic fee based on the pool's imbalance, aiming to offset the potential IL. In gray, we have the waiting zone, which serves as a tolerance range for converting the pool asset into a safe token, avoiding excessive swaps. And by placing some positions in the pool, considering that the current price is at tick X, in the slide, upon receiving information about the swap triggered by the before swap event, you calculate the next tick, which costs in this case is like tick Y, and we then look at the fee charts by each position in the new ticks and calculate the weighted average proportional to the liquidity provided in the ticks by the swap broker, resulting in a fee of approximately 0.57%. The fee charged per tick is calculated by the fee manager contract, which is programmed in Stylus, and when the LP creates or removes a position in a pool. The fees and incentive rewards are deposited into the safe vault contract, which holds the position, and an AVS operator for Eigenlayer listens for an event within the before swap to determine when the position moves out of range. When this happens, it triggers the safe vault contract to remove this liquidity from the position, which is when depositing to it. The AVS also monitors the waiting zone that I mentioned before and the current tick. And when the price reaches the configured tick, it verifies whether the current price is lower than the pool's exit price. If it is, the swap is made to the safe asset. If it's not, the asset's retained to the market because the market's either stable or rising, so it doesn't need any swaps. These prices are retrieved to a chain link oracle that we use to do that. And finally, when the LP closes the position, the hook charges an exit fee of 0.2% in the liquidity and the collected fees. Right now, we're aiming to refine and optimize the work that we completed during this incubation period by conducting code audits, expanding to other networks to attract a broader use base, and also fully integration these advancements into our protocol, Pool Party. The dynamic shield is a very powerful tool designed to minimize impermanent loss, as I said, boost fee collection, and ensure a lot of stability in volatile markets. And it was initially conceived for our pool managers, but it's available now for the entire community, of course. That leads me to the Pool Party protocol, which is a decentralized social finance platform embodying our vision of liquidity provision is for everyone. Pool Party is already live in Arbitrum mainnet, and it's built upon Uniswap v3 today. The protocol simplifies liquidity provision through pool strategies created and managed by specialists, while maintained self-custody for all inexperienced DeFi users or the ones who don't have time, with just 2 clicks, making DeFi accessible and secure for all of them. To achieve all of this, we're currently raising like 600K in funding round with 15 million FTV, and we're looking for a lead investor right now to help us scale this implementation. Funding is primarily allocated to product development, security, and scalability. Of course, if you're interested in being part of this journey with us, yeah, we'd love to discuss it further. Feel free to reach out via email in the screen or Pool Party X as well, and we can arrange a meeting. Let's redefine liquidity provision together. Thank you a lot.
Amazing. Thank you so much. That looks really nice. I think we've talked a lot about, impermanent loss and how hooks can help alleviate some of the impermanent loss we face. I think this is one of the more complete implementations I've seen, and sort of the plan for where it's going as well is very thought out, and pushing the right amount of code over to Stylus, utilizing like the benefits you get of a sort of, the EVM plus environment. Really nicely done. Thank you guys so much. And awesome. Next up, we have Silicon Vision Fund from folks at Semantic Layer. If you could unmute and share screen.
Yeah, sure. Hi everybody. Yeah, it's great to be back at the Uniswap Incubator program again. And happy to present what we built is called Silicon Vision Fund. It is a reference to the like $100 billion the SoftBank Vision Fund. So first the team. Okay, so we're Team Semantic Layer. We're building a transaction sequencing layer, and previously. We co-founded Verilog Solutions, and we're working with smart contract. We're working as smart contract auditors, and
Was it just me, or did he cut off?
Yeah, Dex, I think you might be muted.
Yeah, I was muted. So happy to be back. And something that I've been recently focused on is the idea of automated capitalism, because now we have all those AI agents, and those AI agents, they are like digital native entities, so they can perform actions on chain. And I think it's pretty exciting that we can build all those different infrastructure and DeFi products that are native for the AI agents to use. And what inspired us is actually index products. So if you look at traditional finance, majority of the trading volume actually coming from ETFs and those kind of index products. And we had developers experimenting something similar in the DeFi world as well. So last cycle, we got DeFi Pulse Index, we got Index Co-op, we got all those indexed tokens that track specific sectors like DeFi or Metaverse. Those products are great because they simplify the investment process, and also they provide diversification, meanwhile being very gas efficient. But however, those index tokens kind of fade out because of a couple of reasons. One is that the rebalancing process is prone to MBV. Second is that index products, they're boring. And third problem is that those index tokens, they have a very rigid inclusion rule, meaning that they are very slow to add new assets. If you look at the DeFi Pulse index, it was maintained by DeFi Pulse people. Basically, they're pretty slow on adding new assets. And there's a good reason for that, because you don't want whoever managing the index token could just include new asset this person has a bag of, right? So this is a pretty good reason for that. And this is what made the inclusion process rigid. And we're fixing that by using an AI agent to actually manage the inclusion rule. So AI agents, they will make the decisions of buying or selling tokens in his portfolio. Any of the users, they can make the prompt and make suggestions. And all those prompts, they're public and they're on-chain. So everyone can see, and we can maximize the transparency and also the entertainment value. Just imagine all those shit posts people are going to make. We also added one thing is that we use Uniswap V4 as the value accruing mechanism for this fund. So there's no mint, redeem, NAV mass. If anybody wants to invest in certain AI agent managed fund, they just need to buy the fund token. And if they want to make a suggestion, they just provide the liquidity. And also one interesting question I think is for everybody. Do you think you need to say not financial advice if you're making suggestion to an AI agent? Next, I'm going to actually share our front end. So one thing we made extremely simplified is for the end users. For the end users, all they have to do is just to see all of those tradable SOF funds. Each fund has a specific niche. Like some might be the focus on DeFi, some might be focused on like the bio side, D side coins. You select a specific fund you like to trade. You can see all those different specs. You can see the agent's wallet address, and they can swap from this interface. And if you add liquidity, then you can also attach a prompt. For example, I can suggest the AI agent to include some other coins that are not currently in the portfolio. So today we have those AI agent funds that can manage those on-chain token assets. What we're looking for in the future is actually for AI agents to improve. So in future, we might see some of the large language model LoRa makes those agents like subject matter experts in different niche, like decentralized bioside. And also what we're looking for is that we can in the future integrate with Chainlink, any API, and allow those AI agents to actually reference and do fact checking. And one additional thing we like to do is that right now we deploy a backend on our own server using ChatGPT. But in the future, we can certainly integrate with those decentralized AI inference agents, those AI agents that are running in TEE to make the entire process even more transparent. And people know that those are actually response coming from large language model instead of just having some random dude like replying to people who are sending prompts. Yeah, thank you so much.
Dude, I love it. Welcome back to the semantic layer team. I love your idea. Like every time you come around, you pick a problem that is boring and just make it fun. And we knew AI and crypto was going to overlap. This is honestly everything that's been happening the last couple of months is not how I thought it would overlap, but this is amazing. This is fun. I love it. And shout out to like whoever does your UI UX and I don't like the personal attack meme on there, but I love it. Congratulations, guys. Really fun idea, and looking forward to actually using it on mainnet. Okay, next up we have Battleswaps. So if you unmute and share screen.
Hello.
Hey.
Can you see my screen?
Yep.
Okay, awesome. Okay, cool. So today I'm introducing Battleswaps, a Uniswap v4 game hook. So I'm Dennis, and I'm a full stack developer in Web 2 and Web 3. So what is it? It's actually really simple. It's a game hook. It's built to facilitate multiplayer competitions amongst traders. So traders can take part in these competitions to win prizes, and those prizes can be in the form of tokens or NFTs. And this provides a super interesting trading experience for them. So in Battleswaps, each competition is referred to as a battle, and it requires players to just make some trades as they normally would, but within a certain time frame. And the idea is to outperform their opponent by making much more efficient swaps and win the game. So what's the value being provided? Well, swapping is fun anyway, but the hook will provide even more fun by providing a layer of gamification and really bringing out the competitive side of traders, so they can show off their skills to people, and as well earning prizes as well in the process. And of course, this increased swap activity will result in increased profits for liquidity providers, because the increased volume and the increased fees will mean that both sides get to win. So it's a win-win situation for both traders and liquidity providers. So how does it work? Firstly, any trader can open a battle request, and when they do so, they provide certain battle parameters, such as the duration of the battle, the pool in which the battle will take place, the prize in the form of tokens, some starting balances, and an optional wallet address. So if an optional wallet address is specified, then only that wallet address can take part in that battle. So it's a way of sort of permitting or specifying who can accept the request. But given, let's say that there was no optional wallet address specified, the second step would be to accept that battle request. And once it's accepted, the battle will begin. So there's going to be a time stamp in which the battle will end. So during that, until that timestamp is reached, the participants can just make swaps as usual, and the hook will keep track of the balances over time until finally that timestamp is reached, in which case there is some functionality unlocked that will allow the winning participant to be able to retrieve the prize that was sourced at the beginning of the pool, at the beginning of when the battle request was made. So this is just a technical overview. Probably the main thing to bear in mind here is there are two contracts, the router contract and the hook contract. They're both singleton. And the router contract is where the swaps will be requested. And the hook contract, its main goal is to keep track of the balances. And because it is singleton, it keeps track of all the battles for all trades. So just a couple of things to bear in mind to ensure fair play is that at the start of the battle, both the players must start with the same tokens. So those will be the tokens for the pool, and they'll have to start with the same amounts, and these can be specified. And second of all, it's the hook's role to be able to make certain checks so that the swaps are not exceeding the tracked balance, and if they do, the swap won't be prevented from happening, but it won't count towards the battle score. And a future improvement would be the use of some consumable NFTs, such as an NFT that can prevent the other trader from collecting points for a certain period of time, or it could be an NFT that multiplies their own point collection. So really, it's up to the imagination in what kind of effect these NFTs could have, but it really does introduce an interesting layer of strategy that can be thought about during the battles and the trades. And of course, another future improvement is battle statistics. Everyone likes numbers. Everyone likes to see how well they're doing, how well they're faring compared to other players. So that's another interesting thing to add for a future improvement. And monetization, a small cut can be taken from each battle to be collected by the hook to use as future feature improvements and updates. And thank you for listening. And these are the links to the demo and the back end and the front end and my contact details. Thank you.
Amazing. Thank you so much. First of all, welcome back from UHI too. Love to see alums taking part in these hackathons again. I'm really upset with this presentation because I think what this needed was a collaboration with Silicon Vision Fund, and we need the AI index token agents doing battle swaps now, and I really want to see that. But yeah, they love it. Mimetic Theory says, the world runs on memes, the world runs on entertainment, and anything that makes this whole experience more fun like this, think it's going to be killer and amazing. Great job. And for a solo dev, I think everything you were able to do is pretty well done. And we didn't have a front end demo over here, but the code base really, really well done. Very clean code. I like that. But okay. Thank you so much, Dennis. And
thanks a lot. And I'm always up for collaboration. So yeah, do get in contact.
Yes. Semantic Layer team, reach out. Perfect. Well, next up we have RWASync. If you could unmute and share screen, please.
Yes. Can you hear me?
Yep, perfect.
Yeah, let's start. Hello, we are RWASync. We aspire to develop a user-friendly gateway connecting various real-world assets from Web 2 to Web 3. Our team is building a Korean RWA platform, Alicia, and brought this idea from that experience. Currently, there are many problems of RWAs. First, Uniswap pools have less liquidity compared to traditional asset markets. Therefore, direct swaps may cause significant price slippage. And second, on-chain RWAs lack diversity. The market consists mainly of US Treasury bonds due to limited price oracles for RWAs. And lastly, foreign stocks are difficult to trade in Web 2. While it's easy to buy meme coins, it's unclear how to invest in US private company shares like OpenAI. So we will solve the problems as follows. RWASync hook allows users to stay in Uniswap no matter how they exchange, to mint and redeem or to swap. For example, when swapping large amounts of stock tokens, users can request mint or redeem operations and wait for admins off-chain processing. On the other hand, when the current price is below the peg, you may swap synchronously to take arbitrage. This async swap mechanism can be extended to other pegged assets like Little STETH, where users have to queue their withdrawal requests. And furthermore, ERC 6909 enables free trading while preventing token transfers to unauthorized wallets. It eliminates KYC overhead for individual users. Let's see our demo. First, I will process some tokens. Sorry. First, I will process some tokens. Next, I will swap 50 token 1 to token 0. You can think token 1 is a bond token and token 0 is USDT stablecoin. Let's visit the queue page. The swap is not executed immediately because users have to wait for the admin to sell bonds in the real world and buy USDT with the cash. Before processing the queue, the admin should update the eigenlayer price oracle of the token 1. I create an update request. Then I'm turning on the eigenlayer node operator on the left. It fetches the bond price info from Korean public API. The price is about $7.4. Finally, the admin processes the queued swaps. This minimizes price impacts for large trades. You can see all swaps to token 0 are done at the oracle prices with 0 slippage. We faced several challenges. First, RWASync uses push-based oracle, so I updated the oracle before processing the swap. I'm going to research how to implement a pull-based oracle with eigenlayer. And second, our current implementation requires eigenlayer nodes to pre-agree on specific web endpoints and prepare API keys in advance. This makes it difficult to register a new product instantly. We plan to overcome the challenges with this plan. First, we will adopt real-time on-chain price verification using zkTLS. zkTLS allows flexible Oracle price integration for mint and redeem operations with 0 setup. And this enables instant RWA pool creation as fast as meme coin in pump.fun. We are going to make Uniswap as a super app where users can trade everything. Thank you.
Amazing. I love to see it. I think, we've been talking about RWAs for on-chain like as long as I can remember, 5-6 years, what now? And I think with all the infra we have today, with everything that we have today, we're at a point where we're actually seeing it happen slowly. So I think this is very well thought out. Nice use of Eigen here, I think, instead of relying on specific oracles that only support like hand-picked asset prices. I think making it customized like this in the plan with zkTLS, even though it's not there today, really makes a lot of sense. So really good job. Love to see it. And yes, do everything in Uniswap. I love that. Perfect. Next up, we have PerpDexHook for Sphere. If you could unmute and share screen. Thank you.
Hello, hello. So today I'll be presenting PerpDexHook. The main idea behind PerpDexHook is to turn every CLMM into a mini PerpDex. So the liquidity is basically used synthetically to allow traders to bet with leverage. So a trader just comes with some collateral, token 0, token 1. We rent out the liquidity, they bet, and then we have to lock the LP equivalent liquidity, right? And so the profitable traders are paid out from the LPers, so they have to lose money, and the LPers profit from losses. And on top of that, traders have to pay money to open and keep a position open. So why are we doing this? Well, I believe liquidity is extremely valuable and it's not being used at all in Uniswap. And it's mainly active at the current tick or at a certain price depth, when you're swapping in and out, and the rest isn't doing anything, right? And so I believe that renting liquidity for leverage in those ticks unlocks much higher yields compared to like lending to inactive positions on lending platforms, because it allows you to like kind of double dip versus just being active there and then active in the lending platform. And why I think this is a pretty interesting idea is because, well, there aren't many successful peers, but the ones that are successful, they know how to predict ranges and their time length. And so while impermanent loss, kind of hurts all peers, the ones that kind of can't predict the range and, make enough profit to offset the IL, for them is going to be great because in general, traders make really bad directional bets. Here you can see Hyperliquid has a ton of attention this cycle, and a bunch of traders are just losing money. Right, so I think it's going to benefit the really more maybe institutional or savvy retail traders really well, but also in general all LPers overall. Now, I want to cover specifically why should LPers and traders care about this? Well, obviously you get higher yield, but on top of that, lending only works for a specific amount of tokens, probably around maybe 15, 20. And so this opens up a pool for a lot more tokens to be utilized, or the liquidity at least. And the fees are distributed in pool tokens. So it gives you a lot more a natural exposure versus getting, stablecoin exposure. And why should traders care? This is a trickier one because everybody wants retail flow, Hyperliquid, all the attention it gets, DYDX, the other ones. But if we make the funding fees low enough, I believe there are enough funding arbitrage traders that are going to come in. So this is more for bigger pools. And for probably smaller pools, we should probably, try to get the traders in by allowing leverage for new token launches that aren't on DEXs. So this is a bit technical. Apologies for that, but I didn't think of a good way to do storytelling here. So here you basically, the trader will add the collateral, they'll open the position. Everything is USD denominated, even if you have let's say ETH and Uni. So you take a directional price not on the ratio of them, but on the USD price. And as a trader, you either keep a position open or you close it. So if you keep it open, we have to distribute funding. So longs pay shorts or shorts pay long. And LPs get a percentage of a funding flow, which is very beneficial for them. And then the traders can get liquidated, and if they do, they keep some of the collateral, and the rest of the collateral goes to LPers. Now, if a trader closes a position, well, it depends if they're profitable or not. So if they have losses, basically that amount of collateral goes to LPers, they benefit. And if they profit, well, that means they'll have to go out of LP pool. So we have to lock the realized profit to make sure that LPers cannot rug traders. Now, for the last part is traders removing collateral. So you see that when they close position, nothing really shifts except synthetically. This is to make sure it's a little bit more gas efficient, even though I'm not sure on mainnet it's even possible to do this. So when you remove collateral, if it's below the one you funded, it's very easy. We have enough balance to pay you out. If it's not, then we need to double dip into the LP fees and the buffer capital, and maybe even in the future rebalance LP positions. Now the LP user flow is much simpler. If they add liquidity, we just take some percent of the capital to buffer capital. It doesn't exist now, but easy to add in the future. And as time passes, they earn fees from liquidations, funding, open and closing trades, and the general stuff. If there's a very heavy utilization of your liquidity, we charge higher fees for traders to make sure more liquidity comes up. And if there's heavy open interest imbalance, we just adjust fees between longs and shorts. And then when we want to remove LPers the liquidity, the tricky part is calculating the USD liquidity that the traders did have, and then making sure that LPers can't remove. It's not implemented systematically now. It's very simple solution, but it'll be adjusted in the future. But if LPers are able to remove it, then they just get the tokens and all the fees. Also in the future, in case of lockup, in case of big pools, like let's say ETH, USD or whatever, we want to allow atomically to shift the LP position. And I think that allows just people to, in case they don't like to being locked, they can still rebalance, just go below the current tick and so on, and they have a range that they want again. And now the final frame is improvements. The current stuff I have is a very much a toy model. There's very big trade-offs I took, very gloss over things I took. So it will be have to, revamp architecture, basically for liquidity locking and trader payouts. That's the main stuff. One of those things is, implement buffer capital and fee accrual, and then find an accounting method to avoid rebalancing LP positions. I think that could be a huge thing for this project. And the other stuff is do super heavy simulations for stress testing, because that's the DEXs, the failure rate during stress tests is what matters, because 99% of the time it's chill to operate a DEX. And then just analyze if it's profitable for traders considering gas and fees. So if it's even possible to do this on mainnet, Is it only Optimism, Arbitrum, etc.? And then maybe explore some off-chain heavy optimizations, maybe Arbitrum Stylus, which is not off-chain, but I think that could be super useful. And then the eigenlayer, obviously, stuff. I think that could be great. And that's pretty much it. So thank you for your time.
Amazing. I love this. Even though this is obviously an early stage project, but the amount of thought put into this, the design of how all of this is working, it's very, very impressive. If people in chat as well, like it's very impressive, very elegant. I love this. The code base for this, really nice. And I think the plan moving forward is also well thought out. And I'd love to see this actually deploy, hopefully, and carries on the theme of we'll do everything in Uniswap, right? Love it. Thank you so much. Cool. Next up, we have Dynamic LP Assurance. If you could unmute and share screen.
Hello, am I audible?
Yes.
Yeah. So, hello everybody. Our project is Dynamic LP Assurance Hook. I am Aryan and I have partnered up with Mohak, and we both are college students from India, and we have built this whole project while our exams were going on. So, yeah, so this is a project that is primarily benefiting liquidity providers. And this is a hook that builds up a pool of insurance funds that help out LPs in case when they will suffer from losses in conditions like when impermanent loss hits up, or when there is a lot of volatility. So uh, basically, we provide uh, protection from impermanent loss, and there is a lack of responsive protection, and these kinds of problems are faced by LPs. So what we're doing is providing liquidity providers an innovative insurance pool, which is built into the hook, and we are using NoOp to provide a portion of swaps dynamically to create a sustainable insurance fund. And whenever LPs are withdrawing their liquidity share, then they can get their own insurance fund, which can save them. So via hook, because there is custom logic integration and there is Uniswap integration, that is the perfect infrastructure to build upon, and there is optimized execution. So here we are using stylus to calculate dynamic fees dynamically, insurance fees dynamically, and we are using parameters like the volume and the impermanent loss multiplier and the size of the trade. So we can increase fees when there is a larger trade, but we can still remain in a particular limit through the math that we have done in stylus. And so here in this whole pool, everything is being done through NoOp. So there is no external custody, fund custody in the hook. Everything is being done through ERC6909. So we are using the currency settlement library to do all that, and funds remain into the pool manager. And so we are also leveraging flash loans, and we are using some kind of math to distribute the funds to the LPs based on their share. And we are doing it within Solidity, but we are doing it in a way that is quite optimized. We are using certain variables to do that. And so what is happening is that we can take up flash loans on the funds that are in the pool manager, but those funds are actually distributed to the insurance fund to all the LPs, and that is different from the kind of flash loan that is normally done on swaps. So this is actually building the flash loan fees is actually building up the insurance fund and distributing it every time a swap occurs to the LPs. So we are using a certain kind of math for flash loan fee calculation as well. So which is based upon again historical IL and the base fees and the utilization multiplier, which is also based upon the liquidity that the particular token has. And so the architecture is something like this, where we are, having cross communication with the stylus contract. And the flash loan works something like this. So the flash loan function is on the insurance hook, and whenever someone hits that through their own flash borrower, they take up the loan from us, and we do all the accounting in the pool manager, and we later they have to return us the whole amount plus the fees, and then once we get the whole amount, we distribute it equally to all the LPs, and we calculate their shares, and they can accumulate this whole fees into their insurance fund. And once they remove the liquidity, they can claim the fees. But right now, actually, we had our exams, so we couldn't make a UI for this, but that is a future plan that we plan on doing. So yeah, we plan on designing a front end to interact with this whole thing, and we plan on pool coverage with the support of native tokens, and we plan on enhancing the mathematical models behind this whole thing, plan on optimizing them and making sure they are correct and correct to the T, and actually improving their whole accuracy. And we also want to build out the front end where we can offer various tiers of insurance protection based on what the LPs want, maybe tier 1, tier 2, tier 3, based on how much protection they want against any kind of a calamity that may happen in the future. So yeah, this is the team. I'm Aryan, and this is Mohak, and yeah, we are college students from India doing our BTech, and yeah, this was our whole project. So thank you so much.
Awesome. Congratulations. I have a question for, did you end up passing your exam?
Yeah, we just gave it,
Okay.
so it's not over yet.
Okay,
Yeah.
hopefully it works out. But love that, love the hustle.
Thank you.
Definitely impressive amount of stuff to do in the short amount of time, especially with all that school stuff going on.
Yeah.
And yeah, good stuff like using stylus for, its strengths, shifting all these calculations you have to do over there to make it cheaper for
Yeah.
end users. Really well implemented. Love to see this. Yeah.
Yeah, thank you so much.
Congratulations again. And next up, we have Ember from Sean. So if you could unmute and share screen, please. Thank you.
Good morning, good afternoon, everyone. My name is Shahan Kachajarian. I'm here from Web3 Robots, and I'm here to present Ember, which is a volatility-based dynamic fee hook for Uniswap v4. Ember is built with Arbitrum, and there is a little bit of Brevis that I worked on as well, and I'll talk about how those components fit into the project. As we know, LPs earn from the fees that take place during volatility periods on AMMs. However, when there are low volatility periods, LPers' performance suffer, and also when there are high volatility periods, LPers suffer. Ember is a Uniswap hook backed by an Arbitrum stylus volatility calculator that aims to stabilize fees by applying higher fees to swaps that cause high volatility and to lower fees for swaps that lower volatility. The problem is that...
John, do you want to go on full screen or like presentation mode?
Sure.
Thank you.
Does this work?
Yep.
Thanks. When there are periods of too little volatility, there aren't enough fees being collected by LPs. However, when there's too high volatility, the prices are exiting LP ranges, even if they are efficient. One of the ways that LPers can solve this is by following the price. However, this trailing liquidity leads to increased swap slippage, which also exacerbates volatility. Another issue is that only some traders are causing high volatility, so we don't want the fees to affect all traders. And also on-chain volatility calculations can be expensive, and this can be even further governed by governance parameters. So there needs to be easy ways of calculating volatility and applying it to the swaps that are taking place on the AMM. Ember aims to charge higher fees to only those traders that cause high volatility. This rewards more fees to the LPers. We also can lower the fees for those swaps that are lowering volatility. The efficient volatility calculation is done using Arbitrum stylus, and our implementation can serve either as an oracle or can compute the standard deviation, a typical volatility calculation. The implementation is composed of two main components: the Solidity Uniswap v4 hook, which is implemented as an after swap, and the Arbitrum stylus Rust smart contract, which computes the volatility. All of this runs on an Arbitrum Nitro node, and the integration app is written in TypeScript. There are existing solutions. Naslibin's directional aims to dampen price direction in a general way. There are Uniswap examples of dynamic fees using moving average, and also a dynamic fee oracle. And there are existing Arbitrum stylus smart contracts which compute volatility, such as for Black-Scholes and options calculations. However, these haven't been integrated into Hook solutions as far as I know. So I'll switch to my demo. So here I'm starting the Nitro dev node, and then I'll deploy the cargo stylus smart contract, which is the volatility calculation. And the smart contracts are already built, so we'll next run the integration, which does the Uniswap v4 deployment. It deploys the hook, and then it runs some swaps and dynamically updating the fee. We also show that the fee works when turned off. I'll just switch back to my presentation. There was another component that I was trying to add, which is incomplete, which is Brevis integration. The goal was to take those low volatility traders and give them some control over the AMM's fee. The way that they would be able to do this is by taking their low volatility trades that would have emitted an event. They would take those events and generate a Brevis proof for them. They could then take that proof and submit it to the AMM. And based on how much volatility they had reduced over the past, they could then decide what fee to apply to the AMM. And this would serve in a form of an an auction regulated AMM. We did the prover service, the proving circuit, and the integration of the Brevis callback with the Solidity hook. However, this implementation is not complete until we generate the proof appropriately. We have a few repos for the hook, for the Rust smart contract, and the integration app, as well as our work on the Brevis integration. Thank you. That completes my demo.
Amazing. I think the expansion of like going from something like Neslobin's idea and like thinking about dynamic fees in this regard, in this context, and introducing the idea of like penalizing large volatility traders and sort of giving low volatility traders like using their past trades as a way to like give them some sort of leeway for future larger trades. Really novel idea over there. I think very well implemented, and I've had a lot of conversations in office hours around challenges of doing it this way. So huge shout out on love to see this fully working, and really nice thinking from like first principles about some of these things. So love to see that. Congratulations once again. Cool. Next up, we have CoPoolHook. If you could unmute and share screen.
Oh, can you see my screen?
Yes.
Perfect. Well, hello, my name is Ryan, and I'm here to introduce you to the CoPoolHook for Uniswap v4. So this is essentially a way to create pools that have single-sided liquidity provision and then delegated liquidity management. But in order for me to really show you the value of the CoPoolHook, I need to walk you through why we created it. And it really fits a larger vision protocol called Surety, which we want to launch in 2025. And so that really started with a question. And that question is, why is it so expensive to get on and off chain for non-USD and Euro currencies? You know, I'm based in Australia, and when I want to get on chain, I typically exchange to USD and go through a stable coin, or go to my centralized exchange and then suffer the spread. But we know tokenization works. So what's the go here? All right, how do we lower the cost? Well, the reason why spreads are high is because centralized exchanges have to manage these fiat liquidity pools relevant to the markets that they want to engage, right? So Binance has AUD for its AUD market and other currencies for their other regions. Now, non-USD tokenization exists. We can tokenize Australian dollars, except there's no counterparty token because it's not a reserve asset, right? If you live overseas in Africa, you do not need the Australian dollars, and vice versa. I don't need African currencies. And then, of course, you know, crypto-backed FX exists, but USD and Euro are all that supported. And so the question is, you know, if we lower the fees involved in getting on chain from these various currencies, what does that mean for FX? And so the CoPoolHook essentially fits within this solution, which is aiming to create a single secured on-chain currency fund backed by various fiat currencies in idle reserves. So this is a simple architecture of the larger vision protocol, but you can see here these two primary parties. And on the left side, we have the custodian, who would be one, verifying that they have some custody in a fiat account. And then in order to mint this currency fund, they'd be bonding an asset in order to protect against fraud, essentially. So if I transfer my funds out my bank account, there needs to be a way for the on-chain environment to buy back the currency fund and burn it, right? So there's fraud prevention there. And so what happens when we have a locked asset on chain and a newly minted asset? What can we do with that? Well, we can put it in an AMM, right? But now we have this situation where one party has one side and the other party has the other side. And this is really where the CoPoolHook comes into play. But with the CoPoolHook, we can create that market and allow traders to engage with this newly minted asset and, of course, highly ubiquitous stable coins like USDC. And so here's a quick, small sort of design of what we have in mind for the larger picture. I thought this would be a little bit nicer than showing you some unit tests running on a POC. But I think the more important part is diving into the hook itself. So like I mentioned, what it does is enable single-sided liquidity, which means protocols can now engage the AMM pools that have this hook installed and deposit the asset, delegating that liquidity management to a counterparty. This also helps unsophisticated investors to get involved in Uniswap staking and essentially stake and forget and have the other side manage the liquidity positions. And then, of course, for a liquidity manager, there can be fee dynamics that exist where, because they're leveraging this additional capital that's in the protocol to manage these positions, they can earn more rewards, right? The fee distribution can be adjusted accordingly. And there is a matching process that exists. We have one side, another side, and therefore inside of the hook, we have a matching process. And any unmatched assets, if there's an imbalance, can be allocated to JIT rebalancing as a means to drive down spreads and improve trade efficiency. Now, the larger picture, it's a massive opportunity, I believe. If we can lower costs in getting on chain, we can tap into the FX market. So there's two overlaps there. There is comparable companies like Empower Zero, who are comparable because they're multi-issuer as well. But CoPools can also be general purpose in the fact that, any AMM pool that aims to allow protocols to engage as staking providers can switch on the pool and have that happen for them. And so, yeah, pretty small demo, but the POC is available if you're interested in reviewing the code. Essentially, it proves the fact that Uniswap v4 can be used in this paradigm. And if you're interested in getting in touch with us, please feel free to reach out. We are gearing up for 2025 and hope to raise as well if that's on the table. So thank you.
Amazing. Thank you so much. I think it's a very interesting idea, what we're seeing over here. I'm not sure, like, again, it's a POC stage right now, so it's hard to talk about like future implications. But I think like what you've taught here about the paradigm you're looking at and the context in which you describe this problem, it's really, really interesting to see how you're solving this and how like V4 and hooks come into play. And when I first saw your project and read the description of how we enable single-sided liquidity, I was like, okay, they're just going to do a swap and add liquidity that way. But it grew out to be much more than that, and it's I think very, very nice, very nice way of thinking about this and how you're solving it, and the larger context just makes sense. Amazing, love to see that. Cool. Okay. And last up, we have Autopilot Hook. If you could unmute and share screen, please. Thank you.
Yes. All right. So yes, hello everyone. My name is Regis, and I'm going to present you Autopilot Hook. So Autopilot Hook is Uniswap v4 hook designed to dynamically adjust fees based on market volatility using a machine learning approach. So basically, our model is designed to forecast period of high volatility, allowing us to adapt dynamically the fees in order to protect liquidity provider from impermanent loss. And in period of low volatility, we want the hook to adjust the fees in order to incentivize trading activity. So for this hook, we have implemented 3 technologies. So first of all, Uniswap v4 that allow us to modify the protocol behavior by enabled dynamic fees. Brevis in order to process the data that would be used in our machine learning, and process the data off-chain as it is quite gas intensive to do it on-chain, and using Arbitrum Stylus, unlocking the possibility to use machine learning inside a smart contract by optimizing complex computation. So for this part, we focus mainly our research on ETH USD assets. So the main idea was to create a time frame from a window frame from 15 minutes. And inside this window, we are going to compute the tick variation that's happening and compute the standard deviation. And so this is going to give us 1 point. For the machine learning, to be able to predict and forecast the volatility, we are using the 20 past points in order to predict the next one. For the machine learning model, we are using a linear regression. And in order to ensure the compatibilities with our smart contract, we have decided to scale it, as usually you are going to use float numbers. But here we wanted to use integer for compatibilities. So let's go to the integration. So here we have the Arbitrum Stylus integration where we have our function. We define the different coefficients. As you can see, it's directly integer. And then we are going to see the past 20 points and going to predict and forecast our next point. Regarding the Brevis integration, we are focused on the swap events that are happening. And especially, we are going to look at the tick that we're going to extract. And we are going to compute the tick variation based on 2 swap events happening and be able to compute the standard deviation given a window time frame. In order to kind of ensure the trust of the data, we are also create a ZK proof. So we are computing the standard deviation off-chain, and we are also creating a ZK proof for that. And those information are sent to the smart contract in order to ensure data integrity. And so for the integration, here it's the function that is going to be called by Brevis. We are checking the validation of the ZK proof. We are decoding the last volatility point that we have computed. And then we are calling our function using Arbitrum in order to forecast the volatility. Regarding the future development of this, first of all, we will have to do more backtesting. Indeed, we want to ensure that we have a resilient model, especially in period of high volatility. Also, we can maybe think about to expand beyond each USD assets. Maybe we can think about more exotic ones, and also monitor if the model can also be applied to this, especially with the different volatility we can have. And finally, establish a robust real-time data pipeline for the off-chain process. Regarding the model, we can think about maybe exploring different type of machine learning integration to see maybe more improvement on that. And also regarding the adjustment for the dynamic fees, trying to think about maybe using the magnitude of the forecasted volatility in order to adapt this. So yeah, thank you very much. And if you are interested in this, please reach out. And if you want to learn more, you can either check the GitHub repository or scan it using the QR code. Thank you.
Amazing. I love that. Love the integrations. They just make sense over here. Obviously, it's a proof of concept, so the ML model in question is fairly basic, but that's to be expected given the time frame. But I think as a proof of concept, it does an awesome job of, I think, crypto AI overlap in a different way than prompting agents, which is, no hate. I love those, but the different way of crypto AI overlap. I love it. Awesome. Looks good. Thank you so much. And with that, I think we're at the end of the demo day presentations today. So Bhamik, I'll pass it over to you.
Awesome. Thank you, Hardik. And again, thank you to the presentations. I want to flag again the Hook directory, which is on projects.atrium.academy. We were only able to invite 10 projects to present today out of the 50 plus incredible projects. I urge you guys to scan through the UHI 3 hooks, click through the incredible pages. You can see for each of these hooks, there's context on the background, what problem they were solving, impact, how to contact the developers. So please check out the project directory. But without further ado, let's get into the prize reveal. Want to give quick context on judging. These are the kind of criteria that we evaluated to decide on prize winners. There were sponsor prizes that Arbitrum, Eigenlayer, and Brevis picked themselves. And then there was Atrium Uniswap prizes as well. So very excited to jump in and reveal them. And we're also going to tweet out those prizes at the same time so you can promote. So without further ado, congratulations to these 3 teams for winning the Arbitrum prize. So shout out to Dynamic Shield, shout out to Dynamic LP Assurance and Ember, who we just saw present. Congratulations to these teams for winning the Arbitrum Hook prize. Next up, we have Eigenlayer. So congratulations to Uniguard, Unicow V2 coming back in full swing, and RWASync. Congratulations on winning the prizes for this hackathon. Next up, we have Brevis. The Brevis had 3 incredible projects: Autopilot, Liquidity, Rewards, and Lever. So congratulations to the 3 teams behind it for winning those prizes. Next up, we have the Uniswap and Atrium prize reveal. So there's a few different teams that we're including. So there's 2 images. Congratulations to CoPool, to Fixed Leverage Yield, to Auction Managed AMM, Silicon Vision Fund, Wi-Fi, and White Belt Hook. Congratulations for winning the Atrium and Uniswap Foundation prizes. And then we have 4 of our grand prize winners. Congratulations to Tenor, Battleswaps, PerpDexHook, and GainSwap for winning the top prize from the Uniswap and Atrium Foundation. So we're very excited of these winners, and we actually want you all to promote them live. So we have this tweet queued up that I just posted, as you can see. So if you go on at atrium.academy, we have a thread posted with all the prize winners, links to their projects, and the images that I just shared. And we've tagged all the people on Twitter directly. I want to wrap up by saying, again, congratulations to everyone who participated in this hookathon. This was an incredible experience. We're going to be following up all kinds of graduation email and alumni outreach today and early next week. So thank you for being with us today. And finally, if you know anyone else who would enjoy building on Uniswap, I have to show our applications for cohort 4, sorry for the typo, are live. So you can go directly on Atrium Academy and recommend people to join. But yeah, this wraps up another wonderful demo day and hackathon. Excited to keep up the discussion on Discord and on Telegram for weeks and months to come. Thank you everyone for joining, and yeah, go retweet the prize winners and show some love. Thank you everyone. Hardik, do you want to say anything else?
You much about covered it, but yeah, I just want to say congratulations everybody, and amazing job building. It was really hard with the most number of hooks ever submitted to a hookathon over here. And other than that, I just want to say thank you for bearing with me over the last couple of months. Hopefully, if nothing else, you learned something and had fun, and I'll miss you guys, and shall hopefully keep building, and we'll stay in touch over the Discord. Congratulations once again. Thank you.
Amazing. Bye everyone. See you at the next hookathon. I think normally this is where I also play the song again. I don't know if I should, but I will to wrap it up. Thanks everyone, and I appreciate you all joining. I will end the Zoom recording. Bye bye bye.